Good evening. I want to thank everyone who's joining us on our first call as Great Lakes Private Wealth. This is Dan Murphy, founder and chief investment officer of Great Lakes Private Wealth. As most of you know, on Friday, April 28th, I, along with my team members, resigned from Wells Fargo Advisors and started my own firm, Great Lakes Private Wealth. The responses have been overwhelming, and your complimentary phone calls and emails are greatly appreciated. To those of you who have not heard from us by phone yet, we are diligently working to make sure we individually contact everyone in the timeliest fashion possible. If you would like, please feel free to reach out to us sooner at our new phone number, 248-479-4811. The people that all of you have relied on over the years to be there for you are here with me this evening as a part of Great Lakes Private Wealth. Patin, Carla Stamps, Melissa Hauer, and our newest team member who joined us last year, Ann Nordlaw. The call tonight is being recorded and will be on our website, greatlakesprivatewealth.com, on Wednesday morning. Before getting into my outlook on the stock market, I'd like to take a few minutes to share with you some of the key reasons we decided to go independent and start our own firm. I'll keep it brief, but first, each team member would like to say a few words as members of our new firm, Great Lakes Private Wealth. Here's Carla Stamps.
Good evening, everyone, again. It has been my immense pleasure to serve all of you over the last 13 years as a part of our team. I'm so grateful for the special relationships that we've built as you've shared your hopes, dreams, and family stories with me and allowed me to do the same with you. I hope you all know that all of us here at Great Lakes Private Wealth are driven by the desire to help each of you plan, execute, and reach the goals you've set for yourselves and your families. I count myself blessed to work alongside my team and for the opportunity to be of service to all of you for many years to come.
Now, let's hear from Melissa Hauer.
Having been with Dan for almost 18 years, I feel fortunate to have had the pleasure of not just working with you, but getting to know you. You've graciously shared your life stories. We've celebrated births, graduations, marriages, and sadly, I've also been entrusted with guiding many of you when a loved one has passed. Thank you for allowing me to be there with you through life's ups and downs.
Thanks, Melissa. Now I'd like to introduce Ann Nordlaw.
Good evening. Dan and his team were very highly regarded when I first started out in the industry as a financial advisor over 10 years ago. I was thrilled to have the opportunity to join the team. I look forward to ongoing client interactions, most importantly, making sure there's a seamless transition to Great Lakes Private Wealth. With the resources of Fidelity and Summit behind us, and of course, Dan at the helm, I'm confident that will be the case. I am fortunate to be a part of this team dedicated to making sure all of your financial needs are met. And now I'd like to introduce Patin.
Thanks, Ann. I'm incredibly grateful for the opportunity to have helped clients navigate the complex world of finance over the past 8 years with the team. I started my career paper trading as an intern with Dan, followed by managing the dollars at General Motors Treasurer's office, and I've jointly managed the real dollars that have a real impact for our clients during some of the most challenging environments. Working with good people is one of life's great joys, and I feel incredibly lucky to have that opportunity to work with this amazing team and remarkable clients. Your trust and support have allowed me to grow both personally and professionally, and I look forward to building even stronger relationships with you all at Great Lakes Private Wealth.
Thank you, Pat. Let me share with you some of the key reasons why I decided to start my own independent advisory firm, Great Lakes Private Wealth. We made this move to give you, our cherished clients, family, and friends, a higher level of service and support. Many of you have asked what a fiduciary is and why it's important to be a fiduciary. If you've read any articles recently on picking an advisor, the very first item they recommend in almost all of these articles is the importance of making sure that the firm or person you chose is a fiduciary. We are now registered with the SEC, meaning we have a fiduciary obligation to put the client's best interest first. While we've always operated in a manner consistent with being a fiduciary, we are now formally and legally bound to this exceptional client advisor standard. Another factor was our desire to operate with greater transparency and avoid potential conflicts of interest. As an independent registered investment advisor, we do not receive any commissions or incentives for recommending specific investment products, nor do we have any obligation to sell any proprietary products. Instead, we can now deliver complete, unbiased solutions solely based on what's in our clients' best interests and financial well-being. Another key benefit I'll mention is greater communication. You will see more emails, text, postings, and information on our website. We have less bureaucracy. I can get items approved on a more timely basis and share this information with you, a win for both of us. Once we decided to embrace independence, we wanted to align with a firm with a proven legacy of supporting advisors with full service capabilities and resources and a client-first mentality. Summit Financial provides the infrastructure to allow a seamless move from big warehouse firm to our independent firm, Great Lakes Private Wealth. They were founded 41 years ago, and Summit is a partner in the truest sense of the word, always acting on advisors' behalf to ensure clients receive the exceptional experience we know you deserve. No more 800 numbers or generic email addresses for you. Independent advisors use independent custodians to hold and safeguard clients' assets. This means your money is not being held by the same person who advises you about how to invest it. After thorough due diligence, we've selected Fidelity Institutional as the custodian for Great Lakes Private Wealth. Fidelity is an industry leader with a long and trusted 75-year history of putting clients first and safeguarding investments. They currently have over $4 trillion in custody assets. I'm sure you can tell in my voice how excited my team and I are to be independent and to have you continue this journey with us. Now let's get into what happened in the market in the first quarter and what we see going forward. Pat will give us some data and some information, and then I will update you on the markets. Take it away, Pat.
Thanks, Dan. This is Pat Patin again, partner and portfolio manager of Great Lakes Private Wealth. Before I get started, I must remind everyone that past performance is no guarantee of future results, and all the information we will be providing is from sources we believe to be reliable, but there's no assurance that the information is accurate or complete. So starting off with some key stats for the call, so far year to date, the S&P 500 is up 7.3%. The Dow Jones Industrial Average is up 1.6%. The NASDAQ Composite is up 15.4%. International stocks represented by the EFA Index are up 10.9%. Gold is up 10.5%, and the U.S. Aggregate Bond Market Index is up 2.7%. With that out of the way, the new hot topic in many areas from the investing world to the water cooler is artificial intelligence. From the Microsoft-powered ChatGPT, which is a tool that allows you to have human-like conversations and more with a chatbot, to AI-generated songs featuring your favorite artists, and even a model that can identify cancers in CT scans better than your average doctor. AI is seen by many as the next big wave in innovation. Versions of AI have existed for some time, like Google search results, facial recognition on your phone, to credit card fraud detection. But suddenly, AI seems to be taking over the stock market as well. Year to date, the S&P 500 has been driven by the narrowest stock leadership since the 1990s. AI-themed investments have added $1.4 trillion to the stock market value this year. Just 5 companies, Microsoft, Google, also known as Alphabet, Amazon, Facebook, also known as Meta, and NVIDIA, are responsible for over 90%, yes, 90% of the gains this year for the S&P. and the 10 biggest S&P members have close to their largest index weighting ever. As investors know, you're never invested in just 5 stocks. This brings up the question, how do we know when the stock market is a good value at any given point in time? A key concept that is driving the current outlook and valuation for stock prices is a term we use in the investment business called the equity risk premium. This is the amount of return that investors are getting for investing in stocks. Or said another way, it represents the compensation for uncertainty and volatility that comes with owning stocks. The formal definition of equity risk premium is the gap between the S&P 500's earning yield and the interest rate of the 10-year U.S. Treasury. The reward for owning stocks over bonds has not been this small since October of 2007. The gap currently is around 1.69%. This is well below the average gap since 2008 of 3.5%. This reduction is a challenge for stocks going forward. And the average premium since 1957 is closer to 1.62%. That means stocks should still offer a better return than bonds over the long term, but compared to recent years, this is not as attractive looking at the equity risk premium. In short, investors who want to be invested in stocks need the promise of a higher return than bonds over the long term to offset the risks of owning stocks. Otherwise, the safety of treasury bonds would outweigh the risk of owning stocks. As you can see from the numbers, we are near the lowest equity risk premium since 2007, something that needs to be monitored very closely. With this in mind, the U.S. Federal Reserve faces the challenge of raising interest rates to cool inflation while simultaneously preventing a banking crisis. Having already raised short-term interest rates by a whopping 5% over the last 12 months, this signals we are out of the free money period that the markets have enjoyed for the past 15 years. This change is a far cry from a few years ago when many international government bonds had negative interest rates. Yes, negative interest rates. 30-year mortgages were below 3%, and stimulus checks were passed out en masse. And the term TINA, there is no alternative to stocks, gained popularity. We are now in a new normal, which could be referred to as returning to the old normal before the U.S. Federal Reserve and other central banks lowered interest rates to record lows 3 years ago. We've ridden the wave of low rates for 15 years. That game is over, and a new one is starting. I'll turn it over to Dan to dive deeper into this paradigm shift and what that means for your investments.
Thank you, Pat. Again, good evening, everyone. The first quarter of 2023 has started out on a very strange note. Most of the very best stocks so far of 2023 were some of the very worst stocks of 2022. This is not a rare occurrence. What is rare is the size of the increases in such a small number of names in the S&P 500. As Pat mentioned, 5 names in the S&P 500 have contributed over 90% of the index's total return. 2 examples are Facebook, now called Meta. That stock is up 99% year to date. The next company is NVIDIA, which makes the chips that help run AI. That stock is up 93% year to date. Both of these companies are very large companies and have market capitalizations over $500 billion. If those 5 stocks were not in the S&P 500 index, the market would be up 0.78%. That's right, a little more than 0.75%. That means the other 495 stocks are up a combined less than 1% year to date. The S&P 500 is a capitalization weighted index, and that means that even though there are 500 stocks in the index, the big stocks play a bigger role in the ups and downs in the index's value. Conversely, the smaller names play a much smaller part in the index. It is different with the equal weighted index that measures all 500 stocks equally. not giving any one stock more or less value than the next stock. That index is up 1.1% year to date. That is the second largest spread ever between the two indexes. It highlights a disparity that does not happen very often. If we're to believe that the stock market is a reflection of how the overall economy is doing, then this equal weighted index would lead us to believe that the economy as a whole is starting to struggle under the weight of higher interest rates and persistent inflation. 1 year ago, on May 2nd, the S&P was at 4155. Today, 1 year later, it is at 4119. That's a 1 year decrease of 0.86%. For all practical purposes, the market has gone nowhere over the last 12 months. Now let's talk about the dividend yield on the S&P 500. Pat already talked about the equity risk premium, and I'm now going to be talking about the actual dividend yield that the S&P 500 pays. When the market was at its highs in the year 2000, the dividend yield was 1.1% on the S&P 500. That was the lowest ever. If you remember the year 2000, that was the peak of the dot-com bubble. Stocks sold off dramatically after that. As a comparison to that, at the lows in the market in March of 2009, the dividend yield on the S&P 500 was 3.6%. Another date for comparison is October of 2011, after the U.S. debt rating got downgraded from AAA status. The dividend yield then was 2.12%. More recently, the yield at the lows in the stock market during the COVID pandemic in March of 2020 was 2.25%. Today, the yield on the S&P 500 is 1.65%. Historically, we see these spikes in dividend yield has been a good signal for when the stock market may be approaching a low. As you can see, when we compare the dividend yield today versus March of 2009, March of 2020, or even October of 2011, we are not at the levels where historically prices are near the low. Of course, this is based just on the dividend yield of the S&P 500. Again, it's just one signpost on our journey to navigate the stock market. All of this data comes from ycharts.com. The two factors that the stock market has been hyper-focused on this year is interest rates and inflation. Let's tackle inflation first. The CPI in March was up 0.1% from the prior month and up 5% on an annualized basis. Let's review some of the key components of inflation that everyone can relate to. Lumber, a key item needed to build homes, is down 67% from 1 year ago. Steel to build factories and automobiles is down 28% from 1 year ago. Remember when Russia invaded Ukraine a little over a year and a few months ago, we thought Europe was going to freeze to death due to the lack of supplies of natural gas. Natural gas is down 71% from a year ago. Crude oil is down 25%, even with OPEC cutting supply a month ago. What about some food items? The big one everyone noticed was eggs, which at one point were up over 100% at one point during the year due to bird flu. Today, egg prices are down 43% from a year ago. Wheat, which is one of the key commodities produced in Ukraine, is down 45% year over year. And the last area I want to touch on that everyone is talking about is electric vehicle production. Every automobile firm is coming out with a new electric vehicle. Lithium, one of the key components of electric batteries, is down 62% from a year ago. Many thought with all these electric cars being built, we might run out of lithium because we're going to need so much for all the new electric vehicles. The bottom line here is that inflation in commodities is lower than a year ago. If the economy continues to weaken or we go into a minor recession, we can surmise that inflation will fall even further than it already has fallen. And this data comes from tradingeconomics.com. Now let's talk about the other key factor that everyone is focused on in the investment community, interest rates. Over a year ago, the Federal Reserve stated they were not worried about inflation and they felt it was transitory. They could not have been more incorrect on this issue. Interest rates on the federal funds rate have gone up almost 5% in 1 year. This is an unprecedented amount in such a short amount of time. Just 1 year ago, the 30-year mortgage was 5.1%, and today it is at 6.43%. And this data is from Freddie Mac. Everyone saw what interest rates did to the stock market last year. Typically, when rates are rising, the stock market goes sideways to down. Interesting, though, on January 1st of this year, the yield on the 10-year Treasury was at 3.88%. Today, the yield on the 10-year Treasury is 3.45. So even though the Federal Reserve has raised short-term interest rates by 75 basis points this year, the yield on the 10-year Treasury has fallen 0.43%. The Federal Reserve is meeting today and tomorrow, and they will report at 2 p.m. what action they are taking with interest rates. The markets are anticipating another 0.25% interest rate increase tomorrow. I believe the Federal Reserve will raise rates by 0.25% tomorrow. Many traders and economists see the economy weakening throughout the balance of this year and expect this increase to be the last increase of 2023. If that is the case, that certainly would be a positive for the stock market. The next issue is, when do we believe the Federal Reserve will start to lower rates, which would be very bullish in my opinion? I think the Federal Reserve is very hesitant to lower rates because they're so concerned about the potential for reigniting inflation. They would prefer the economy weaken a little more before embarking on lower interest rates. I'll share my opinion in a little bit on my thoughts on the direction of interest rates a little bit later. I would be remiss if I did not spend a little bit of time discussing the recent bank failures that have occurred since March of this year. First, we had Silicon Valley Bank go bust. Then we had Signature Bank go out of business. And just this last weekend, the FDIC took over First Republic Bank. The government held an auction and JP Morgan was the winner. These banks had invested their depositors' money into longer-term treasuries, and when the Federal Reserve started raising interest rates, the value of these bonds that the banks had invested the depositors' money into dropped in value substantially. Then, when the depositors wanted to get their money out of the banks, unfortunately, the value of the bonds had dropped by so much that they did not have enough funds to pay back the depositors. Bloomberg reported on March the 10th that depositors pulled out a record $42 billion in 1 day from Silicon Valley Bank. This is what ultimately led to the failure of Silicon Valley Bank. It was called the greatest bank run in history. If you think about it, this amounts to $4.2 billion an hour, or $1 million a second. That's a lot of money pulled out in a very short amount of time. There is no bank that can handle these kinds of demands on their deposit base. In this digital age that we live in, everyone can move their money from one institution to another with just a few clicks on a laptop computer or a click on their phone. This is a new paradigm that banks need to prepare for. I don't think any bank was ready for this kind of outflow in such a short amount of time. These are what we call unintended consequences caused by the very quick increase in interest rates by the Federal Reserve. These banks were just not prepared and did not have enough liquidity on hand. Let me talk for a little bit about what I believe the implications for the economy and other banks are by the failures of these three banks. The first implication for all banks is they will want to keep more cash on hand than normal to make sure they have ample liquidity going forward, just as a precaution. As the economy slows, the public and corporations will keep more cash on hand than normal. Once their cash is gone, though, they will begin to use credit lines for corporations and credit cards for the public. The second implication for banks is that the economy has slowed, and as rates have risen, banks have begun to tighten credit standards, which in turn means they are not loaning out as much money to the public and businesses. This slower lending then leads to a slowing economy, creating a vicious circle for the economy. An example of tighter credit standards that we're seeing already is Ally Bank closed down the credit line of USA Auto Sales, a seller of used cars to the public. They had 39 dealerships in the U.S., and they had to close them all because they lost their line of credit. This is just one example of the effect of tighter credit conditions can have on the economy. The third implication on the economy is the potential from legislatures and government to invoke stricter rules on banks on how much cash they have to keep on hand and what they can invest their excess funds that they have on hand. None of these is positive for bank stocks or the economy. The availability of funds from the government and the banks is the lifeblood for the growth in the economy. If the Federal Reserve and banks are not loaning money to the public and businesses, it is certainly negative for the U.S. economy. Another factor facing banks is how the commercial real estate market is doing since COVID. We have a high vacancy rates in commercial real estate, and they're getting even worse. Bloomberg reported that the vacancy rates in New York are still between 30 and 50% in many buildings. Many of these commercial buildings have been purchased with mortgages. These mortgages are provided for by many small banks, insurance companies, and real estate investment trusts. In fact, Axios reported on March 8th of this year that 67% of all commercial real estate loans are provided by small domestic banks. Small and domestic banks are defined as banks smaller than the top 25 banks in the country. Believe it or not, there are a total of 4,800 small and mid-sized banks. So the fact that they hold 67% of all the commercial real estate loans and they're being held by smaller banks has some people very worried. The commercial real estate market is estimated to be $20 trillion in size, just to give you an idea how big that market is. Again, we need to watch this very closely going forward. To see if the public is doing better or worse as it relates to credit conditions and how their credit is doing, last Friday we got some real-world data from Capital One Financial, which reported that their earnings were 41% below estimates. What I noticed in the report that I read was that provisions for credit losses were much higher than expected. In fact, they were 39% higher than expected. And credit card delinquencies rose from 2.38% a year ago to 3.68% this year. This is a sign that consumers are feeling stretched, to say the least. And as interest rates go higher and the economy slows down, people will start to be forced to miss payments on everything from car loans to credit cards to mortgage payments. Again, if this trend were to continue, it would be a clear sign the economy is entering a more difficult period for sure. Again, another signpost we're watching very closely. Now, you say, where has all this money gone? Where was the money that was pulled out of the banks ended up? Much of it has gone into the top 3 to 5 major banks. But the clearest winner has been the money market funds. Investors have poured $508 billion into money markets in the first quarter of this year. Again, $508 billion into money market funds in the first quarter. If you ranked all the mutual funds by flows in March, the top 28 would all be money market funds. They also made up 73 of the top 100. About $30 billion alone poured into money market funds in the week of April the 12th, taking total assets in money market funds to $5.28 trillion. The previous record was $5.25 trillion, which was set a week before and exceeding the prior high in 2008 and 2020. Another factor that may lead to some slowing in the economy is the repayment of student loan debt. Since COVID, the repayment of student debt has been on hold. At the end of June, the moratorium will be lifted, and that will make individual budgets even tighter and will leave them with less cash to spend in the economy. I'll spend a few minutes on investor sentiment. Currently, we're getting conflicting signals on sentiment today. First, the CNN Fear and Greed Index that I talk about is currently at 51, which is neutral. The Ned Davis Research indicator on sentiment is in the neutral range as well. The American Association of Individual Investors sentiment as of last 30 was at 37% neutral, 38 bearish, and 24 bullish. Last September's bearishness, when we were at the lows, had 60.9% bearish and only 17% bullish, and neutral then was at 21. So we're in the middle of the range. But a survey from JP Morgan's clients recently found that 95% of investors think stocks will fall the rest of the year, with the remaining 4.5% thinking prices will stay where they are, and only 0.5% of investors surveyed think the stock market prices will rise this year. The survey shows sentiment from JP Morgan's banking clients is very negative on the outlook for stocks this year. That usually is a positive sign. So you can see why I say we're getting conflicting signals from many different surveys and data. If we get a big sell-off in the weeks, months to come, we could see these surveys and the data get very negative, which would ultimately be a sign to start adding funds to the stock market. There's an old saying that goes, sell in May and go away. The data over the last 10 years, though, has shown that May has been down in value only once, and that was 2019, down once in 10 years. What is different this May is the fact that we've had such a large increase in interest rates, and we have a debt ceiling issue overhang. The Treasury Secretary yesterday said the U.S. government has until June 1st before they run out of cash. Because of such historically low interest rates over the last 10 years, I believe the data has been skewed to the positive side of the ledger. If we look back over a longer period of time, the phrase refers to an investment strategy for stocks based on the theory that stock markets underperform in the 6-month period between May and October. Since 1945, the S&P index has gained an average of 6.7% between November and April, compared to the average gain of only 2% between May and October. That data comes from the Center for Financial Research and Analysis. We're keeping more cash on hand in our portfolios just in case we get a decent sell-off in equity prices, and then we'll be able to allocate the cash into the market at lower prices. The nice thing today is we are getting paid on our money market accounts at an interest rate of over 4%. So we can wait until to invest our excess cash when we feel it's the best time. Let me now share my thoughts on the outlook of inflation and interest rates and the direction of the stock market. First, inflation is definitely slowing, and I believe will continue to drop towards the 3% range. The reason I don't think it will go much lower than that in the short term is due to wage inflation that is going to stay higher for longer. To protect company earnings, companies will be very slow to lower prices. We also have some major companies this summer negotiating very large labor contracts. So wage increases are starting to slow, but it takes a lot longer for us to see the effect of lower prices when we're having all of these wage increases. I believe inflation will fall closer to the 3% range versus the 6 to 8% inflation of the last 12 months. This will allow the Federal Reserve, I believe, to stop raising rates and even possibly lower them slightly sometime in the future. Bottom line, the pressure of higher rates, I believe, will be lifting shortly. The Federal Reserve has said they would prefer to see long-term inflation around 2 to 2.25%. This will take longer to see, and I don't think we'll see that until sometime in 2024. With the banking crisis that has occurred in the last 2 months and tighter credit conditions, banks are not going to be willing to lend money, and this will lead to a slowing in the economy. This will help take the pressure off inflation and will help slow the economy as well. As I said a second ago, if the economy slows like I think it will, this will force the Federal Reserve to stop raising interest rates, and they may even have to begin lowering rates depending on how much the economy slows. Again, we'll be watching the economy very closely over the next several months. Now for the big kahuna, the stock market. I think we could get a nice rally at some point when the stock market believes the Federal Reserve has stopped raising interest rates. This will in turn lead to a very nice stock market rally. Then we'll have to see if the economy is recovering or slowing further. If the economy gets even slower, then you may see the stock market take another step lower. We just can't predict how much the economy will slow at this time. No one can. I think there's a chance at some point we will test the lows of last September or October of 22. Many of the most accurate prognosticators of the last couple of years are predicting another substantial sell-off before year end due to economic weakness they believe will show up in the economy. At this time, the indicators are not projecting that. We are more in a sideways period where the market goes up and down and up and down, and 6 months from now we'll see probably where we've gone nowhere, very similar to the last 12 months in the market. With 3 large banks failing in the last 2 months, it's essential that you have your assets managed by a team of experienced professionals who are dedicated to your investment success. I've been managing money since 1992, and I've navigated the most difficult of times. Many of you know that firsthand since you've been clients of mine for over 25 years, that we've been able to navigate these difficult periods, and we've gotten your portfolios through them very successfully for you and your family. Newer clients, this may be your first time to experience difficult markets. These are definitely unique times for markets for sure. Experience today is more important than ever when it comes to managing your money. As I said in the video that you all should have received, as the owner of Great Lakes Private Wealth, our success is intertwined now. We take this very seriously. When you succeed, we succeed. We are truly independent. Our goals are totally aligned. And I want to thank you for listening and thank you for all the notes and calls over the last few days. We really appreciate it. Good night, and I look forward to our next call in July.